Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 consumer-focused tech stocks to buy before earnings. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into the 3 stocks, I want to quickly do a broader earnings recap, and clearly there's a lot going on and a lot of uncertainty at the moment heading into the election. There's also the continued unknown of the coronavirus, and Wall Street has focused on the possibility of increased lockdown measures in parts of Europe, in the US as we head into winter. So I don't want to focus on those unknowns because that being the operative word, unknowns. So instead, we're going to focus on what we do know, and that is the overall earnings picture, which continues to improve. We saw solid quarterly results from the biggest names in the market last week, and those are those big tech giants. So Apple, Amazon, Google, parent Alphabet, Facebook, and Microsoft all reported results last week. The market didn't react particularly well, but that is more likely a result of people taking profits on these stocks that are up big in 2020 and during the market's comeback from its March lows. And in fact, if you look at their fundamentals, in their outlooks, these stocks remain honestly as strong as ever. And obviously, the one thing holding over some of these companies is the possibility of further government intervention, which could play a major role. So it's obviously worth keeping an eye on that. But once again, that's another unknown factor on that side. So if we look at the market as a whole, the technology sector, this is just to show we live in a tech-focused world, and the tech sector matters a lot in terms of earnings. So if we look at that, the tech sector in general as part of the S&P 500 is expected to account for about 30% of the S&P 500 index's total earnings, and this is in 2021, so next year. For reference, finance is expected to account for about 20%, and energy is expected to account for 2%. So we have 30% for tech, 20% for finance, and 2% for energy. So that just shows how much the technology sector matters in terms of the broader market and its earnings. So if we look at Q3 as a whole, tech sector earnings are expected to be up about 9%, and this is based on our most recent Zacks data from the same period last year on about 7% higher revenue. And if we look at total Q3 S&P 500 earnings, they're projected to sink about 10.5% as of our most recent data on about 3% lower revenue. And this would mark a big improvement from Q2, when we saw the earnings decline about 32% on 7% lower revenue. So that was kind of that height of the coronavirus lockdowns of the pandemic. And then if we look ahead to Q4, those results are trending upward as well. And then if we look at the annual outlook, Zacks data is calling for overall S&P 500 earnings to decline 19% in fiscal 2020 on about 4.5% lower revenue. So this is for the full year. And then if we look ahead to 2021, we're calling for earnings to bounce back in a big way, up about 24% next year. Obviously, this is an easier to compare period, but trending in the right direction on 7.5% higher revenue. So this data helps support the idea that the economy continues to trend in the right direction. We saw that in GDP data that came out last Thursday. So overall, despite all of the unknowns of the president and the coronavirus, the data that we do have is suggesting that the market and these big companies are heading in the right direction as they're trending upward from their coronavirus lows. And before we get into the 3 stocks, I wanted to read something from my boss and the director of research here at Zacks. He wrote this last Friday when he was laying out the different bull and bear cases for the market heading past the election and into 2021. And so this is his conclusion after he lays this all out. So I'm just to read a couple paragraphs at the end, just because he has a good sense of all of this. He's been doing this for a very long time. And he was actually, I'm kicking myself still to this day, because earlier this year, he wrote a piece about a week before the market hit its bottom, saying exactly that the market has hit its bottom. The earnings picture is telling us this. And 3 days after he wrote that piece, the market hit its bottom on March 23rd, and it's gone up ever since. Obviously, there's been a little bit of a pullback, but just he's very data focused, maybe the most unbiased person I know. So this is his outlook on the market in the broader sense. So, quote, I don't dismiss the bearish arguments entirely, but I don't see them adding up to an extended downturn for the U.S. economy and an end of the spectacular rally we've seen so far since it got underway on March 23rd. The reality is that we have learned enough through the lockdowns to navigate the transition period when we engage in economic activities, even as the pathogen is still among us. The health of the U.S. economy ahead of the pandemic and the very strong fiscal and monetary response, coupled with the pent-up demand, ensures that the economic recovery will only gain strength going forward. The worst of the pandemic's economic and corporate earnings impact is already behind us, with the earnings picture already starting to improve. As regular readers of my earnings commentary know, the earnings picture has notably improved, with estimates for Q4 and beyond starting to go up in recent days. The markets are forward-looking pricing mechanisms. They have already discounted the pandemic-driven growth hit and is looking forward to the aforementioned turnaround in earnings outlook. Continued confirmation of this favorable trend will further strengthen bullish sentiment in the market. These are historic times for the economy and the market. The historic times create historic opportunity. All in all, this is the best time to be fully invested in the market, particularly if you're investing for the long haul. So all this to say is with the interest rates, two things move stocks in the long term: interest rates and earnings. Earnings are trending in the right direction, and interest rates are historically low. This is bullish signals for stocks if we can block out all of the broader noise. So now we're going to look at the three tech companies we're going to talk about today that are reporting their quarterly results later in the week. And the first stock we're going to look at is Square. That trades under the ticker SQ. And the company is expected to release their third quarter results on Thursday, November 5th. So we're quickly going to break down a little bit of Square's business and then look at some of the recent results before we look ahead. So Square has come a long way from the firm that sold small smartphone and tablet connected credit card readers geared towards small, micro-sized businesses, the self-employed. Today, its portfolio includes a range of point-of-sale offerings, a broader payment infrastructure, including robust online portion, as well as debit cards, small business loans, peer-to-peer payment app, Bitcoin buying, and more. We should note that the company's Cash App, which is widely popular, competes against PayPal's Venmo, and then similar offerings where you can pay other people, pay bills through the big banks like JP Morgan and others. Many of Square's clients, their business clients, were coffee shops, restaurants, bars, smaller brick and mortar businesses, and they have been negatively impacted by the coronavirus. Still, if we look back, its Q1 revenue jumped 44%, and then its second quarter results were even more impressive as people continue to opt to put their stimulus checks from the government into the Cash App. So more direct deposits, more money floating around in that Cash App ecosystem. So with that in mind, its second quarter revenue soared 64%, which marked its strongest growth as a public firm, and came despite the fact that its gross payment volume actually slipped about 15% amid the height of those lockdown periods in the second quarter, where a lot of quote unquote non-essential brick and mortar businesses were closed. The Cash App's gross profit was up about 170%, and the company had over 30 million monthly transacting active customers and over 7 million spending on its cash card. So overall, Wall Street was really happy to see that Square consumers are starting to use more of its banking features, and this is all part of the company's goal to become the modern bank for our tech-focused world. And we should also note, this is a really positive sign, that its seller business saw its volumes return to growth in July, and its online gross payment volume jumped 50% to account for 25% of seller volume in the second quarter. So even as its brick and mortar business took a hit, those businesses many of them were able to shift to online focused sales. So Square has crushed its rival PayPal over the last 3 years. It's up about 330% despite some ups and downs. As of Monday morning, it was trading at around $157 per share, which puts it about 17% off its mid-October highs, which might make it even more enticing for some investors. And even though it's easily crushed its industry and PayPal over the last several years, it's actually trading at a discount compared to both. So it's trading at about 8.3 times forward sales against both its industry and PayPal, which are trading at about 9.3 times forward sales at the moment. So looking ahead, Zacks estimates are calling for Square's revenue to soar about 70% in both Q3 and Q4, which would top last quarter's record growth. Despite this projected top-line expansion, its adjusted earnings are projected to fall 44% in the quarter and 13% in Q4. But if we look over the long haul, both its top and bottom line are trending in the right direction. So its fiscal 2020 revenue is projected to climb 57% to $7.4 billion, with FY21 projected to climb another 30% higher to about $9.5 billion. This would follow growth of 43% in 2019, and 49% in 2018, and then 30% in 2017. So some really impressive top-line growth for Square. And then its adjusted earnings are expected to slip about 36% this year to 51 cents per share, with FY21 then projected to jump 115% higher all the way up to $111 per share. So trending in the right direction after the coronavirus really shook up some of its core business. So the company has seen some positive earnings estimate revisions recently to help it earn a Zacks rank number 2 buy at the moment, and it crushed our bottom line estimates last quarter. So with that said, obviously some investors might not want to buy a stock right before earnings, but if you have a longer term horizon with Square sitting about 17% off its highs, it's a solid play on the broader fintech space in our digital economy that's continuing to become more digitally focused every day, with every type of business having mostly the ability to buy and sell things online. But as we said, the uncertainty of this week and maybe the next several weeks with the election, some people might not want to buy. If you have a near-term outlook, that said, longer-term investors should certainly consider Square stock for the long haul as that bet on that fintech space, as we mentioned. So now we're going to move on to another big name in the tech space that's consumer-facing, and that is Alibaba. The stock trades under the ticker BABA. It has outclimbed its U.S. counterpart Amazon over the last 6 months, which is no easy task. And the company is also coming off a strong quarter, and the Chinese economy has started to grow just as the U.S. economy has returned to growth as well in Q3. So with this in mind, let's see what's going on with the company overall and take a look at last quarter and then looking ahead before they also report their results on Thursday, November 5th. So Alibaba reportedly controls about 2/3 of the Chinese e-commerce market, and the company's ability to expand its reach in the world's most populated country alongside the likes of JD.com could help it grow for years to come. And it's really always worth remembering that China's middle class could hit about 550 million people by 2022, and this is according to a McKinsey report. And this number alone is far larger than the entire U.S. population of around 330 million. So the Chinese population and its growing middle class, Alibaba should be able to benefit from that for years to come. So if we look at last quarter, Alibaba's annual active customers hit 742 million, with its mobile monthly active users up 28 million sequentially to over 874 million. This helped Alibaba's sales pop about 30%, and its adjusted earnings climb 18% to top our estimates. So aside from e-commerce, Alibaba, like Amazon, also has a digital media unit and an ever-expanding cloud computing segment. So its cloud segment surged 59% last quarter to account for about 10% of total sales, and its digital media space was up 9%. And we should note that China is one of the only markets in the world that Netflix does not operate in. So it's always helpful for a Chinese business to have a digital media leg in our world today. And more recently, we should note that the company announced on October 18th that it would spend about $3.6 billion to take a controlling stake of Sun Art Retail Group, which is China's largest big box retailer that competes alongside Walmart in the world's second largest economy. So that could be something to watch going forward. The company also stands to benefit from Ant Group's record-breaking IPO, the technology and financial services giant, which is run by Jack Ma, who used to run Alibaba and co-founded the company. It owns a widely popular mobile payment platform, Alipay, that competes alongside WeChat Pay in China's very digitally focused, heavy economy where lots of people buy things, even from street vendors, on their cell phones. So that's very important for Alibaba going forward. Alibaba reportedly holds a 33% stake in the fintech firm that's going to only expand in that digital economy over in China. So with this in mind, Alibaba stock is up 55% in the last 6 months. This tops Amazon's 35%, and the gap has grown even wider in the last 3 months, with Alibaba up 20% against Amazon's roughly 4% decline. This is part of a much larger run that's seen Alibaba climb over 250% in the last 5 years, and it currently hovers around 3% off its recent highs. That said, the company's valuation is hardly that stretched considering where it's traded over the last years as well, which is good to note, as the stock is sitting not too far off its all-time highs. So looking ahead, our Zacks estimates are calling for its second quarter earnings to climb 13% on 38% higher sales, with its full year earnings expected to jump 23% on 36% stronger revenue. And then they're expected to follow up this growth with another 20% expansion on both the top and bottom lines in fiscal 2022. In like Square, Alibaba's positive longer-term earnings revisions activity, helps it earn a Zacks rank number 2 buy at the moment as well. And like with Square, this is a bet on the future of the economy. Alibaba, like Amazon, e-commerce, cloud computing, digital media, they're going to expand in China, expand elsewhere. In Asia, it's worth considering as a longer term play on all of these things that are only becoming more popular in not only China and the US, but elsewhere in the world. And obviously, just like with Square, near term, it's a little less certain, but longer term, the stock certainly seems to be worth considering. And then the last stock we're going to take a look at is a little bit different than these two stocks, but it's within this broader consumer-focused tech space world, and that is Peloton. It trades under the ticker PTON. Its shares have actually fallen about 20% since the middle of October as part of a broader market pullback amid some of the election uncertainty in the rise in coronavirus cases that we talked about at the top of the show. So that said, the high-tech workout stationary bike company is still up over 280% in 2020, and it's really built for continued growth beyond the pandemic. So now we're going to take a look at Peloton more broadly. So Peloton was founded in 2012 and went public in 2019. The firm sells connected bikes that give users the ability to follow along with classes on their built-in connected TV monitors. Peloton then in early September announced that it was offering new bikes and new pricing models and also new treadmills. So the company's new Peloton Bike Plus, that Plus moniker is now everywhere. And then the new Peloton Tread Plus. They cost more and are set to offer members, quote, new ways to combine cardio and strength training. So the new Peloton, they lowered the price of their original Peloton. So the original Peloton bike runs $1,895, which was a 16% discount against the original price and 25% lower than the new Bike Plus. So they're just offering two different price points to gain entry into this high-end, high-tech bike company, with the new Bike Plus starting at around $2,500. And it's also worth noting that you can just pay monthly installments on both the treadmill and the bike. So meanwhile, the Tread Plus starts at $4,300, with the other treadmill offering now starting at $2,400. $500. So very expensive, but also more importantly, the company makes money from its monthly subscription memberships. So it's $39 a month for its all access membership, while also customers who don't own a Peloton or Peloton equipment can pay about $13 a month for access to these classes that allow them to follow along with indoor cycling, running, strength training, and more. So the high-end, high-tech home workout company has attracted more customers as gyms are closed around the country. And clearly the coronavirus continues to hamper businesses that are based on people being in close quarters. So this is from airline travel to movie theaters. And it's hard to imagine that people will race back to gyms even when things return closer to normal. So this could propel Peloton's growth for a while, especially if people come to enjoy the convenience from at-home workouts. So the New York-based company was growing also before the virus, so that is really worth noting as well. It's not just a total pandemic play. People were buying these home bikes before they had to work out from home. This is part of a group of higher end, new age connected fitness products. This includes Mirror, which Lululemon has spent $500 million to buy, as well as different companies that have rowing machines and bikes as well. We should also note the company that owns Bowflex and Nautilus, which is Nautilus. It trades under the ticker NLS. It has seen its stocks skyrocket 1,000% in 2020. We should also note that Apple recently has committed to diving deeper into the fitness world as part of its larger subscription services business. So with this in mind, Peloton stock, as we mentioned, is down about 20% since the middle of October, and it's seen some downgrades, including from Goldman Sachs. That said, they lowered their rating from a buy to neutral, pointing to shipment delays and its overheated price, but the analyst still saw it as a solid longer-term play, and he actually lifted his 12-month price target from $138 per share to $140 per share. And as I mentioned, they pointed to shipment delays. So because of all this demand, Peloton currently has a message posted on its website. So if you go to try to buy a Peloton, it's right at the top. It's flashing, letting you know. Most bike deliveries times are 5 to 10 weeks. Bike Plus delivery times may exceed 12 weeks. And as I mentioned, this is according to their website directly. So the longer wait times for delivery and installation have become common during the pandemic, but this hasn't stopped the company from posting some really eye-popping sales figures. So this higher demand has also created manufacturing backlogs, which the company is trying to solve at the moment. So if we look last quarter, which was their Q4 results, the company's revenue soared 172% to over $600 million, with its fiscal 2020 revenue up 100% to $1.8 billion, which marked an impressive follow-up from its 110% expansion in 2019. So it already expanded 110% long before the virus was a thing, and then it did another 100% growth in fiscal 2020. It's fiscal 2020. So meanwhile, its connected fitness subscription jumped 113% to over 1 million, with its paid digital subscriptions up 210% to over 300,000. And it's also worth noting that people aren't just buying this and not using it. Its workouts are up 330% in Q4. And despite Peloton stock being up 360% in the last year and 60% in the last 3 months, it trades at just 8.3 times forward 12-month sales, which marks a discount compared to Lululemon. And if we look at fellow pandemic high flyers such as Zoom Video, that's trading all the way at 47 times forward 12-month sales. So at 8.3 times forward sales, it's trading at a discount compared to a growth company like Lululemon. So it gives you some perspective. So looking ahead, Zach's estimates call for Peloton's first quarter FY21 revenue to jump 220% all the way up to about $730 million. And if we look ahead to fiscal 2021, it's projected to soar another 98%. So from 1.8 billion in the year last, so fiscal 20, all the way up to 3.61 billion. And then if we look ahead, it's expected to climb another 34% or $1.2 billion higher in FY 2022, all the way up to 4.83 billion. So they just did 1.8 billion in sales this past year. they're expected to do $3.6 billion in sales this year, and then looking ahead to the next year, all the way up to $4.8 billion in sales. So that's some really impressive growth for Peloton. That certainly makes it worth considering as a play for the coronavirus and beyond. Along with its impressive top line outlook, Peloton is projected to swing from an adjusted loss of $1.29 per share to positive 13 cents per share this quarter. And this trend is expected to continue for the full year, with it expected to climb from an adjusted loss of 32 cents per share to positive 25 cents per share this year, all the way up to then 55 cents per share in fiscal 2022. So unlike Square and Alibaba, the stock is a Zacks rank number 3 hold at the moment, heading into its release, which is also expected to come out on Thursday, November 5th. Even though it has a Zacks rank number 3 hold, the company has seen some longer term earnings revisions over the last 90 days. It also earns a grade for growth in our style score system, and its leisure and recreational products industry rests in the top 20% of over 250 Zacks industries. So all in all, Peloton seems like a worthwhile stock to consider for this coronavirus that, as I mentioned, it's unlikely gyms are just going to be packed anytime soon, especially in big cities like New York and Chicago and LA and places where people are perhaps buying these very expensive at-home workout equipment. And as I mentioned, it's not just for really rich people. You can spend, I think it's $49 a month to slowly pay these things off. So that might be appealing to lots of people who no longer are going to the gym. So they're now just going to pay this as sort of a membership fee over an extended period of time and then eventually own it. As we mentioned, though, with all three of these stocks, anything could happen in the near term, given all of the uncertainty. So it's always riskier to play these stocks for any near-term post-earnings gains. So all three of these stocks look to be solid longer-term plays on where the economy is headed, both during the coronavirus and beyond. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.